Hi everybody, my name is Matiss. I'm the co-founder and CEO of Creamfinance. The title of the presentation is Smart Data, Simple Loans. And the reason for this is because if you're a fintech company and if you don't use the word data at least once in every single sentence, then you're not cool. So I just wanted to stay in the trend and be cool. But to be honest, it really represents how we think about the future of consumer financial services and especially consumer lending. So that's that. In terms of what I want to cover, I'll talk about Creamfinance in the broader context of Fintech, and I'll focus on risk management and data management, as we've heard a lot about this already, as well as our experience of international expansion, how we've gone into all these different markets in a fairly short period of time, and then I'll wrap up with what I think are the current Fintech challenges and trends that we're facing in this hot industry. And so back to Creamfinance. Our mission is to make money available. And what we do is we provide consumer loans online, starting from a few €100 for a few days, few months, all the way up to a few €1,000 for a few years and anything in between. Yeah? And what we do is we really focus on three things. One is one-click loan convenience. Yeah? So we want to make borrowing money online as simple as clicking one click. So if you're a consumer, you come to the website, you read the loan contract, you select the product that you want, and you click apply, and you get the money to your account like instantly. Yeah? That's where we are going as a company. That's one. Second is we use what's called smart data as opposed to big data for analyzing our clients, verifying them, and so on and so forth. The difference between smart and big is that big data, which is the buzzword that we hear a lot, is all concerned with getting huge amounts of data and analyzing them in a very speedy manner, very quickly. Whereas smart data is more concerned with the accuracy and the value of the data that you have in your hands. And the third point is we believe that focus is power, meaning there's, especially in the fintech space, and more senior bankers will be a testament to that, there's a lot of these startups that try to disrupt banks and create these multitude of services to be digital banks. Yeah? But what happens is most of the times they're just providing very mediocre service in every single product category. So they do asset management, they do lending, they do consulting and all sorts of other financial services. But we believe that if you want to be excellent, you really stick to what you know. Yeah? And we know how to underwrite non-secured consumer loans. And we want to do that around the world and be able to do it at a convenience where you literally come to the website and you get a loan with one click. Yeah? That's kind of the future of the business, and that's where we're taking it. Now, this gives a bit of an overview of where are we now as a company. So we started, and I hope the guys in the back can at least see a little bit. We started in 2012 in a country called Latvia, a small country in the Baltic states. That's myself and my business partner. Now we are in 7 countries worldwide, mostly in Europe. So we went into Czech, into Slovakia, into Poland, into Georgia, into Austria, now into Denmark and also Mexico. So we're kind of going outside of Europe also. We have over 200 people working in the company, 220 people, with a central office in Poland, in Warsaw. We've reached over 30 million in revenue. Revenue, that means not amount of money that we give out to the clients, but the actual interest that we collect. And we're profitable, yeah? Which is very different from a lot of fast growth online, cool businesses. We actually are profitable. And we've raised over 50 million euros in capital, both in private and public markets. And so this growth has enabled us to become the fastest or the second fastest growing company in Europe, according to the Inc. magazine, which we're happy about. And these boxes just give you an idea now of our core markets and how much of these markets are generating for us in terms of revenue. So you obviously can see Poland is bigger now, but this split is changing as we grow bigger. And what's interesting is we of course didn't start off like that. Yeah? In 2011, late 2011, 2012, we were a small startup. This is our very first office, which is not really an office, it's just a desk space. And the reason I'm telling this is because we didn't start off with this idea of raising millions and millions at a unicorn valuation just to play around with some cool, crazy ideas and see if it works down the line. We started very much in a bootstrapped way, using other people's money from kind of connections and friends. And so we knew that we cannot afford to lose money. We were never in a position to kind of, do some crazy stuff. So that's why the DNA of the company for us has always been operational excellence first, yeah, and scale second, or scaling, comes second. And that has kind of dictated, how we think about building the business in all these different countries. And most importantly, that we had to focus on risk management from day one. And I'll talk about that in the next slides. So we have a very hands-on approach to risk management, which we think is one of the, fintech industry leading, especially in Europe, in order to deliver this one-click convenience for our end consumer. And so let's talk about risk management a little bit, how we look at it in our company. So in our opinion, risk management, and I'll talk specifically more around the credit risk, meaning what are the probabilities and chances that if we give money to clients that we eventually get it back, and that's what we call default, the percentage of money that we eventually lose for those that are not in the industry. And you have to focus on both sides of risk management. Both sides of risk management. One side is what we call the scoring side, or the credit worthiness assessment. How do you figure out, using all sorts of data, whether the client will, give you the money back or not? That's one. Second is the collection side. How do you get money back from clients that for some reason have gone into default, are overdue on the payments? Only when you focus on these two components of risk management and strike a very good balance between the two of them, can you get, really strong industry-leading results in your default levels, in your risk management and KPIs. And again, for those that are not in the industry, maybe don't see it immediately, but the point is many companies, starting from banks to fintech startups and all sorts of companies in between, they mostly focus on one side of this equation or the other side of the equation, because that's easier. It's not easy to get both of these components right. So let me talk about both sides of the equation in a bit more detail. So the first side, the scoring, the credit worthiness assessment side. What we do there is quite a few interesting things, and just to note, our default levels, and we were talking with some of the guys at lunch, is about 6-7%, in some countries as low as 4%, which is significantly lower than the industry average of approximately 10-11%. So we do have some confidence to say that we know what we're talking about. And on the scoring side, one thing that we do a lot is we gather a lot of what we call smart data. Basically, it's non-traditional data. We can see if you're applying for a loan on our website from an iPhone 4 or a Galaxy 5S. We can see if you've browsed in different other websites before you came to our website. We can see if you spent no more than 2 seconds reading the loan contract, which is not a good sign, and all sorts of stuff like that. We see how you move the mouse on the website. It gives an indication of how much in rush you are to make an application for the loan. We see what text, or how do you fill out the registration form? Do you make mistakes? You use capital letters, small letters, and all these kind of little intricate things give some idea of the credit worthiness of a client. And that's just tip of the iceberg. And then, in parallel, we have simplistically speaking, a machine learning algorithm process, which is basically a statistical process that takes all this data, combines it with more traditional credit bureau data, and comes up with projected probabilities of default on all these individual loan applications. And what's important is, like I said, we do it in a smart data way. So we're not obsessed with just gathering all the data that's out there, or everything that's possible, because we've learned, unlike some of our competitors, that the price of, or the cost of extracting data, the cost of processing this data, oftentimes exceeds the benefits that you get in kind of like knowing everything about your clients. So you have to still be traditional and critical that this is not all about like, you know, getting as much data as possible, because all this costs money. Yeah? You have to look at the, you know, the value and the accuracy of the data that you're using. So that's on the scoring side. On the collections, which is the other component of risk management and credit risk management, we have automated in-house call centers that provide the collections capability for us across the board, across the countries. It's built around what we call an auto dialer. Yeah? It's basically an algorithm that crawls all the, you know, clients that are overdue and automatically dials out to these clients, and only the client that does pick up, and as you might imagine, not everybody picks up when they owe money, only someone that picks up gets connected to our actual operator that sits behind the screen, and they get a pre-populated window with all the information, and then they start speaking to the client. And that seems like, you know, it makes sense, it's logical, but in the industry it really helps us reduce the time of just simply waiting for a client to pick up. And those are a lot of efficiencies that we bring to the table with the focus on automation and technology. Also on the collection side, we have what we call a real-time allocations algorithm. So there's an algorithm which calculates how to split and how to allocate the excess portfolio that we generate in our overdue clients. So let's say if we have a certain amount of overdue clients that come in into one specific date, the algorithm figures out whether we send that to a third-party debt collection agency, do we collect it in-house based on various characteristics, all with the intention to maximize the rate of return for our company. Yeah? And so, like I said, so what happens is most of the times, or often, lenders, they are really good at one part of this component or the other, very rarely on both. And what is funny is that nowadays in this super hot area where people invest money and there's all these Silicon Valley companies, fintech startups really focus on the scoring side, because that's the more sexy one to talk about in conferences and with investors and so on. It's all about data and gathering as much data as possible. But the funny thing is, if you just focus on the scoring, as you see from this simple illustration, you really miss out half of the business. Yeah? You have to get both of those components right. And as an illustration of how it works in Creamfinance in terms of numbers, this chart gives you our portfolio over the last 2-3 years in the blue bars by month. And the dark green line, which is going down, is our default level. Yeah? So as we are growing the portfolio, our defaults are getting better versus the industry average of about 10%. Yeah? And our job is not to get down to zero, because in that case we're taking too little risk. We don't want that. Our job is to know how to control this green line. And that's on the risk management side. Now, like I said, so we've been focused on getting the operational performance and operational excellence first, and then thinking about scaling. You know, once we really built out this risk management kind of, you know, model and system, then we focused on a highly replicable international expansion strategy. Yeah? And so I'll give you a brief, you know, thought process of how we go into different markets. And we do it by what we call foreign direct investment, which means when we look into a new country, we don't just translate our website to the local language and say that we do business in that country. We set up the whole office there, we hire people, you know, we build a real presence in every single country in which we operate. We get all the trading licenses to be fully compliant with regulation and so on. And what we do then is we start lending these small amounts of money for short durations, with the idea to generate this risk management know-how, both on the scoring side and the collections side, as fast as possible. And it takes us months, not years or decades. It takes us months to build out a, you know, coherent, solid picture of a consumer behavior in terms of credit risk in every market that we go into. Yeah? And that's kind of the beauty of the model that we deploy. And then of course it takes us anywhere from a year, 2 years, depending on how big the risk appetite we're ready to take on, to scale the business to get to profitability. Yeah? And what's interesting, the last point on the bottom corner about the new country search. Yeah? We look at new countries and open up new countries by pure trial and error approach with a limited budget. And what it means is we don't do excessive planning. We don't do business plans. I've never done a business plan in my life. What we do is instead we have one or two guys in the company. They constantly monitor different types of countries around the world. If we find something interesting, then we literally in 2 months, 3 months max, we set up a small representative office, a small operation. We then start lending a little bit of money, and if the data comes in good and it seems reasonable and kind of confirms our hypothesis, then of course we continue and we scale more. If not, we are very happy and not shy of the fact of that we close a business in a new country. And with this strategy, we get to a position where we have quite a few countries for a small, medium type business. And then it becomes important of how do we manage all these different countries and how do we figure out the split between what we centralize, what we localize. Yeah? So the matrix management element becomes really important and tricky. And when it comes to the team split, where do we find the people? How do we build out the different teams and the presence of these different teams if we have all these different countries potentially where we could position these teams? And the one rule that we've learned and come across and figured out for ourselves is that you build teams wherever you can find the best people. Yeah? So distance does not matter, as long as you're not talking about holiday. Distance does not matter in our case. Yeah? In Creamfinance, we have our central office in Poland, in Warsaw. That's where most of our top management sits. Our IT is in Austria. Yeah? Our risk management is in Latvia. Our marketing is in Czech Republic, and so on and so forth. And when we started out the business, everybody was saying that this is not a sustainable long-term kind of structure of how to manage your people and your team, and you're going to run into difficulty as you're going to scale and grow bigger. And we did several times year over year, and it still works as good as at the beginning. Yeah? As long as Skype is on, then it's fine. And the last 2 points, so another question is, how do you figure out the split of what to centralize and what to localize in terms of the functions in your business? And again, through a lot of experimenting, a lot of mistakes, we have learned very clearly that everything that is concerned with revenue, with sales generation, needs to be fully localized. The local team needs to have a full authority and responsibility to figure out how to generate sales in these different countries. Everything that concerns controls needs to be centralized in our business, in our case, because we have different markets. They move at different speeds. They have different characteristics, and only having a very centralized performance and control, management toolbox can give you ability to really move the whole company ahead. So that's central and local. And the last point here in managing several markets is, how do you actually build out a team in this individual country? And we've done a lot of mistakes. We paid a lot for this to figure out the right formula. And for us, the right formula is really to build a local team top down, starting from a local MD, a managing director or CEO. You hire that person, and that person builds out the team underneath him or her, yeah? And you give the resources. We have tried in the beginning kind of vice versa, the opposite way, where myself and my business partner, we're both from Latvia, we would go to Czech Republic, which was our first expansion market. We would do everything ourselves. We would hire the people, try to kind of bring this mentality of sort of Latvian business to Czech Republic, thinking that it's going to be cool. But it didn't work. For the first 2 years, we just couldn't scale the business. The final note and the final topic I want to touch upon is the more general trends in fintech and challenges that I think we're now facing in fintech. And I want to start off with a hypothesis that fintech kind of globally is fairly hot and a bit overhyped at this stage. Hence the kind of hypothesis of a bubble. For those that are not in the industry, what's very funny, if you go to any of these trade events, conferences like Money 2020 or others, those conferences and gatherings in fintech, they're more like indulgent entertainment events. Yeah, they don't have water on the table, they sometimes have vodka, or whatever. And there's companies, startups that have raised like millions from VCs, and they all talk about disrupting banks, making the world a better place, disrupting everything without having raised, or without having acquired a single client, or having no revenue or no profits. Yeah? And that's kind of like a bit it makes us a bit cautious. And then there's media, and then there's VCs that all celebrate how much money is raised as opposed to how much money is made, for shareholders, which is what you talked about. And that's, again, it's a bit weird. And then there's an obsession with unicorns. Yeah? All sorts of events and reports and fancy stuff is created just to celebrate how many unicorns we have in this space. And what's funny is we looked at one VC, which is very prominent, and they are based in Singapore. They focus on investing in fintech only. And this is just an extraction from their report, super colorful with pictures, very nice. And this shows basically an investment globally into fintech over the last 5 years, which is obviously growing very fast. And this VC is stating, proudly that in 2013 there were 3 unicorns in the fintech space. Yeah? And in 2015 there are over 50 unicorns in fintech. And they're saying this is amazing, and we should have more, and we should just go and keep growing. Yeah? And this is the kind of sentiment that makes us, fairly cautious and worried. And that's something I just wanted to bring up. But I don't want to finish off on a negative note. I do want to point out several, more visible, out of many trends, but the more visible trends in fintech that are fundamentally changing, the quality of the consumer financial services and the companies that are kind of doing this. So one is very evident, is new fintech companies are really cutting costs and improving the quality of certain areas of consumer financial services, like mobile and internet payments. It's one of the very visible ones where banks are kind of falling a bit behind. And you might have heard of different companies. TransferWise is just one that is more popular, let's say. Not the only one by any means. That's one trend that is happening and is fundamentally providing a better experience for the consumer, both from the price and quality perspective. Second is, as I was talking about, new fintech companies are providing new and interesting and innovative ways of managing risks. Everything from credit risk, fraud checks, scoring, and all sorts of other risk management tools are created because of this new way of tracking and gathering data, and because of new means of generating data through smartphones and so on. And Creamfinance and others are examples of that trend. And the last point is, again, with a lot of new fintech companies, or few fundamentally sound fintech companies, there are more interesting ways for consumers to deposit money and get very good interest on their deposits, and also for the consumers to borrow at more competitive rates than before. And so this creates more diverse credit landscape. An examples of such companies that are the best in this space are peer-to-peer lenders and credit marketplaces where people can both invest money and borrow money. Yeah? And that's something that literally didn't exist up until 2004 and 2005. So I think that's pretty much all I wanted to cover. So I just welcome you to stay critical of hot fintech trends, and also in the meantime engage with companies that have solid and sound financials. Thank you. Ladies and gentlemen.